Awesome. And we do have a question, and
Okay.
please get questions. We got one in the chat window from Deepak. Great to have you. What is the expense we are paying for on these policies? Basically, how much of the premium goes into commissions and profits for the mutual company and the policy sellers? Basically, what is the management fee?
Yeah. Well, so let me answer this way, and I'll kind of go into detail. There's never a dime that you're going to pay other than the premium amount that you want to put in the policy. So anyway, Deepak, let's say you want to put in $1,000 a month into the policy, or 10,000 a year, whatever number that is. Again, 200 a month, 3 million a year, whatever number that is. That money goes into your policy. In other words, the check that you write that to the insurance company. All right. And so, like, on that amount of premium that you put in, based on your age and your health, that's going to buy you X amount of death benefit. So that money goes into the insurance company. You don't write me a check for a dime. Remember earlier on the call, I said I get paid one way only. I get paid a commission on your policy. The same way if you go buy car insurance from John Smith, the Allstate man, the check that you write is not to John Smith. You write it to Allstate. Allstate pays John Smith a commission. All right. So the insurance company determines the amount of commission they pay us, the agent. Now, obviously, the more premium that you put into the policy, the happier I am, because I get more commission on the higher premium. But it's all based on a percentage of what you're putting in. So that money goes into the insurance company. That's all you ever pay. You pay for that. The insurance company, in return, they give you the policy with X amount of death benefit. Now, that is your policy. And on that policy, you have a cash value or a loan availability on it. Now, the reason you want to use me and not the guy down the street is because the guy down the street doesn't understand the banking concept. And if he did or she did, then why haven't they told you already? But let's just make believe that they do understand it. But they're going to be very hesitant and skeptical to design your policy this way. Because in order to design the policy this way to where you have high immediate cash value, and remember my definition of immediate is within the first 30 days, the agent has to take a 60 to 90 percent cut in their commission in order to design the policy this way. And they're not willing to do it. They are not going to take that hit in the commission. That's why all policies that you've ever seen, probably, I'm assuming, up to this date, okay, in a whole life policy, there's zero cash value in the first year, zero in the second year, or very little, and not much more in the third year, because all that money, all that extra money goes into the pocket for agent's commission. When we design your policy, we snuggle it right up to the MEC line without going over it. So we take a significant hit in our commission. So it all comes in to the design of the policy. So we're taking a 60 to 90% cut in the commission. But just to make sure I completely answered your question, I don't determine what the commission is from the insurance company. The insurance company determines the commission based on the policy that you're buying. And all we do is one type of policy. We do whole life policies in mutual companies that pay dividends, that's designed for high immediate cash value. So it's not an IUL. I mean, I would love to sell you an IUL. I'd make way more commission on it, but I would never buy one because I would never sell one, right? Again, I said that backwards. I would never sell one because I would never buy one, right? So again, these are whole life policies in mutual companies that pay dividends that are designed for high immediate cash value. It's not an IUL. It's not a UL. It's not a variable life. It's not a term. It's a whole life policy at a mutual company that pays dividends. I hope that answered the question. If not,
well, I think one of the, if I'm reading into his question, and I think I'm understanding where he's coming from, when you look at a perspective on a mutual fund, right? And we've all seen this. And I know Tony Robbins talks about this a lot in his book. He's like, you always want to look at the fees, because he goes, a lot of your money that you're putting in, if you don't realize it, it's going to get gobbled up in fees, and then you're really not making any money. And so I think that's really where he's coming from in his question, is anything that he's putting in there getting gobbled up with fees that's going to lower his rate of cash value and growth.
Yeah, absolutely. And again, I completely understand where people think of fees because they're so used to qualified plans. They're so used to 401ks. They're so used to Edward Jones, AG Edwards, T. Rowe Price, Charles Schwab, where fees, 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 fees. Whether you win or you lose, they get their fees. This is not like that. You get the contract and you see exactly what's going in your policy, and exactly what's going in is the premium that you put in. And on that contract, you have two columns. You have a guaranteed column and a non-guaranteed column. And it tells you what the cash value is. It tells you what the loan availability is, which is essentially the cash value. And then it tells you what the death benefit is. Those numbers continue to increase year after year because it's a guaranteed growth. There's no extra fees. There's no extra charges. So if you die in a year, this is what the death benefit pays out. If you die in 10 years, this is what the death benefit paid out. There's two columns, guaranteed and non-guaranteed. The only difference between guaranteed and non-guaranteed is the dividends. The dividends are never guaranteed. However, every company we use has been paying dividends for over 120 consecutive years without fail. Does that mean they're going to pay this year, next year, 10 years from now? No, but chances are they are. So because they have been doing it for 120 plus years. So there's kind of a joke that we have in the whole life industry. Whenever you put money in a whole life policy, the guaranteed column really means it's not guaranteed to be what it says, because it's going to be somewhere north of that, somewhere higher, because they're going to pay a dividend. We just don't know what it's going to be. So that's why every year on your policy anniversary day, we want you to get what we call an in-force illustration. And on that in-force illustration, you can see exactly where your policy is. So did it perform better or worse than what was projected? And do that every single year and you will see the numbers. But there's no extra fees. There's no extra charges. You pay the money that goes in the policy and you will see what those numbers are on the guaranteed side from now until the time you're age 121. And when you get to age 121, past then, the insurance company just pays you your death benefit. They don't want to play ball with you. They don't want to play with you in the sandbox and go past age 121. So when you get there, we'll talk about it.